What if the biggest story in finance right now has nothing to do with price charts, nothing to do with market cap rankings, and nothing to do with what any influencer is telling you to buy? What if the real story is buried inside a 70-page technical report published by the Bank for International Settlements that almost nobody has read? What if the global banking system, the same system that has resisted change for 5 decades, is not choosing to upgrade, but is being mathematically forced to? Today, we are not talking about speculation. We are not talking about theories. We are talking about the cold, hard arithmetic of global liquidity and why that arithmetic leads to one unavoidable conclusion. Welcome back to Token Frontline. Let's start with a number: $10 trillion. That is not the US national debt, although we will get to that. That is not the market cap of global equities. $10 trillion is the estimated amount of capital that is sitting completely idle right now today in what the banking world calls nostro and vostro accounts. These are the pre-funded accounts that banks around the world are required to maintain just to make sure cross-border payments can actually land on the other side. Here is how it works. When a bank in London wants to send money to a bank in Singapore, it cannot just snap its fingers and move value across the globe instantly. It needs to have money already sitting in Singapore, pre-positioned, waiting. A dormant pool of capital parked in every major currency corridor around the world, doing absolutely nothing, earning nothing, existing solely as a buffer for the possibility that a payment might need to land there. For decades, banks accepted this cost as the price of doing business internationally. But that calculation has changed dramatically. In a world of rising interest rates, that $10 trillion sitting idle is not just an inefficiency. It is an existential competitive disadvantage. Every $1 billion locked in a nostro account is $1 billion that cannot be lent out, cannot be invested, cannot generate returns. The opportunity cost is staggering. And the banks know it. This is the problem that was considered unsolvable for 50 years. Until it wasn't. To understand why the solution exists now and not a decade ago, you need to understand something called ISO 2022. This might sound like the name of a government form, and in a sense it is, but it is arguably the most important technical standard in the history of modern finance. ISO 2022 is the new universal language of global banking. It is being mandated, not suggested, mandated, across every major financial jurisdiction on Earth. The Federal Reserve adopted it. SWIFT migrated to it. The European Central Bank runs on it. For the first time in history, every bank, every payment system, every central bank in the world is being required to speak the same structured digital language. Now here is where most people stop thinking and where the real insight begins. ISO 2022 makes the messaging faster. It makes the instructions richer, more detailed, more automated. But it does not by itself move the actual value any faster. You can send a beautifully formatted ISO 2022 compliant digital message that says, "Please transfer $500 million from Frankfurt to Tokyo." And the actual settlement of that money can still take 3 to 5 business days to fully clear through the correspondent banking chain. You have upgraded the envelope. You have not upgraded the mail carrier. And in a world where consumers, corporations, and governments are demanding instant settlement, where a person in Brazil expects their international payment to land in seconds the way a domestic payment does, a 3-day settlement window is not just slow, it is dangerous. Every day, a transaction sits uncleared. It carries what regulators call settlement risk. The risk that something goes wrong between the instruction and the completion. Banks carry billions of dollars in this unsettled exposure every single day. It is a systemic vulnerability hiding in plain sight. This is the gap between the speed of the message and the speed of the money. And this gap is where XRP was engineered to live. The XRP ledger settles transactions in 3 to 5 seconds. Not minutes, not hours, not days, seconds. And it does this at a cost measured in fractions of a cent, at a throughput capable of handling the volume that global finance actually requires. This is not marketing language. These are the operational specifications of a ledger that has been running continuously since 2012, through bull markets and bear markets, through regulatory battles and technical stress tests, without a single day of downtime. Ripple's on-demand liquidity product, which uses XRP as the bridge asset, allows a bank to convert a payment from one currency to XRP and from XRP to the destination currency in a single fluid motion. No pre-funded accounts required. No capital sitting idle in Singapore or Frankfurt or Nairobi. Just-in-time liquidity, sourced from a global market, settled in seconds. The banks that have piloted this system are reporting operational cost reductions in the range of 40 to 60% on their cross-border payment corridors. Let that number sit with you for a moment. In an industry where a 1% efficiency gain generates headlines, a 60% reduction in the cost of moving money internationally is not an upgrade. It is a restructuring of the entire economics of the business. Now layer on top of this the CBDC question, because this is where the story gets genuinely complex and genuinely important. Almost every major central bank in the world is currently developing, piloting, or deploying a central bank digital currency. The digital dollar, the digital euro, the digital yuan, the digital rial. These are not crypto in the retail sense. They are sovereign digital currencies, issued and controlled by governments, designed to modernize the infrastructure of money itself. But here is the problem that the architects of these systems are losing sleep over. Digital currencies, like the analog currencies they replace, are national. A digital dollar is a digital dollar. A digital euro is a digital euro. And when a Brazilian company wants to pay a Japanese supplier, those two digital currencies do not automatically speak to each other. They are silos, sovereign digital silos. If the world successfully transitions to CBDCs without solving the interoperability problem, we do not move forward. We move backward into a more fragmented financial system than we have today. More walls, not fewer. The solution to this problem requires a neutral intermediary, an asset that belongs to no government, that carries no political alignment, that can sit between a digital dollar and a digital yuan and facilitate a clean, instant, bilateral exchange without either nation having to trust the other's currency. That requirement, neutrality, speed, scale, and regulatory acceptance, is an extraordinarily narrow filter. An XRP is one of the very few assets in existence that passes through it. This is not an opinion being offered by XRP enthusiasts on social media. This is the functional requirement being specified in technical working papers published by the Bank for International Settlements and the International Monetary Fund. The language they use is different. They talk about interoperability layers and bridge assets and settlement finality. But the architecture they are describing is exactly what the XRP ledger was built to provide. Let's talk about something called the tokenization wave, because this is the next chapter of this story, and it is arriving faster than most people realize. BlackRock, Fidelity, Franklin Templeton. These are not crypto companies. These are the oldest and most conservative asset managers on the planet. And they are actively building infrastructure to tokenize real-world assets, government bonds, private equity, real estate, commodities, and move them onto blockchain ledgers. When you tokenize a $500 million commercial real estate portfolio, you need a ledger that can hold it transfer it and settle it without failure. You need a bridge currency that can provide liquidity for that transaction without requiring a buyer and a seller to be holding the exact same asset in the exact same moment. The scale and the technical requirements of tokenized asset markets make the requirements of the cross-border payment problem look simple by comparison. The XRP ledger is one of a small number of ledgers in the world that is carbon neutral, battle-tested at scale, and capable of hosting tokenized real-world assets with the compliance features that institutional adoption requires. This is not a future capability being promised in a white paper. It is a present capability that is operational today. Now let's address something that every serious observer of this space has to acknowledge honestly. The regulatory environment in the United States created years of uncertainty that slowed institutional adoption in the world's largest capital market. The legal questions around whether XRP constituted a security were not trivial questions. They had real consequences for how banks, asset managers, and exchanges could engage with the asset. That chapter is not fully closed, but the landscape has shifted materially. The core finding that XRP itself, traded on public exchanges, does not constitute a security was a significant legal development. And the broader regulatory direction in the United States and globally is moving toward frameworks that give institutions the clarity they need to integrate digital assets into their core operations. The institutional floodgates do not open all at once. They open corridor by corridor, jurisdiction by jurisdiction, as compliance teams get comfortable and legal frameworks solidify. But the direction of that movement is clear, and the assets that will benefit most from institutional adoption are not the ones with the loudest retail communities. They are the ones with the deepest institutional infrastructure already in place. Here is the competitive dynamic that makes this a forced transition rather than an optional one. Imagine two banks operating in the same cross-border payment corridor, say, between the United States and Mexico, one of the highest volume remittance corridors in the world. Bank A integrates an on-demand liquidity solution using XRP. They can now offer their customers a transfer that lands in seconds, with a fee that is a fraction of the traditional wire cost, with no capital tied up in pre-funded accounts. Bank B continues operating on the correspondent banking model. Their transfer takes 3 days. Their fee is $30 plus a spread on the exchange rate. Their capital efficiency is the same as it was in 1990. In a competitive market, Bank B does not need to make a philosophical decision about whether they believe in blockchain technology. They need to make a survival decision. The moment customers begin to experience the difference between these two services, the choice becomes obvious. And once a critical mass of banks in a corridor adopt the faster, cheaper system, the network effect accelerates adoption across the entire corridor. This is not a prediction based on hope. It is the same dynamic that replaced fax machines with email, that replaced physical video rental with streaming, that replaced paper maps with GPS navigation. The better infrastructure does not win eventually, it wins inevitably. The only variable is the timeline. And on the question of timeline, the signals coming from the Middle East, from Southeast Asia, from the UK, and from the payment corridors being built across Africa suggest that the timeline is compressing faster than most retail observers appreciate. The volume moving through ODL corridors has grown substantially. The number of institutional partners working with Ripple's technology is in the hundreds. The regulatory frameworks in Singapore, the UAE, and the UK are creating the conditions for large-scale deployment. The boring, technical gears of the global financial system are turning. They do not turn quickly. They do not turn with announcements or press conferences. They turn in quarterly bank reports, in BIS working papers, in ISO compliance deadlines, and in the quiet integration work happening inside the technology departments of institutions whose names you would recognize immediately. The question worth sitting with is not whether this transition is happening. The evidence that it is happening is documented, public, and verifiable. The question worth sitting with is what stage of the transition we are actually in, and whether the timeline is months, years, or a decade. History suggests that technological transitions of this magnitude follow a consistent pattern. They are dismissed, then debated, then gradually adopted, then suddenly they are everywhere and the previous system feels like an artifact. We are somewhere in the middle of that curve. The dismissal phase is largely over. The debate phase is ongoing. The gradual adoption phase has clearly begun. What you watch for, if you're watching the right signals, is not the daily price. It is the corridor volume. It is the regulatory calendar. It is the tokenization deployments. It is the CBDC interoperability frameworks. It is the things that the banks are watching, because the banks are not looking at the 4-hour chart. They are looking at the 10-year systemic shift. The real story of XRP is not found in speculation. It is found in the plumbing of the world. It is found in the technical requirement that the digital economy cannot run on analog settlement infrastructure. It is found in the mathematical reality that $10 trillion of idle capital is a problem that the banking system can no longer afford to ignore. The banks are not adopting this technology because they want to. They are adopting it because the alternative, staying on 50-year-old infrastructure while competitors cut their costs by 60%, is not a viable business strategy. I want to hear from you in the comments. Do you think this transition happens as a gradual climb, corridor by corridor, bank by bank, over the next 5 to 10 years? Or do you think there is a point of critical mass where the old system simply cannot compete and the shift becomes sudden? Drop your perspective below. This is not a trivial question. The answer shapes how you think about the entire timeline. If this video gave you a clearer picture of the infrastructure story behind the headlines, share it with someone who is watching the price and missing the actual thesis. The price follows the utility. The utility is being built right now. Don't forget to subscribe to Token Frontline for more analysis that skips the noise and goes straight to the mechanics. We don't follow the hype. We follow the liquidity. This is Token Frontline, and the future is being built in the code. See you in the next one.